Welcome to Elite Finance Insights, your gateway to the financial secrets of the world's most iconic success stories. Every tip we share is a key to the strategies once reserved for the elite. Ready to unlock your financial potential? Let's dive in. And it's Wednesday again. You know what that means. Today, as always, we have our special weekly update where we break down 3 crucial economic events shaping the U.S. market. We'll reveal the most impactful news of the day and explain how these developments might influence your investments, whether it's in crypto, ETFs, or other market sectors. Stay tuned as we dive into today's market-moving insights. Hello and welcome back. In today's update, I'm excited to take you through 3 major headlines that are poised to make waves in the financial world. We'll start with the latest signals coming from the Federal Reserve regarding its monetary policy, move on to a historic infrastructure spending bill passed by Congress, and finally, delve into the unveiling of a new regulatory framework for cryptocurrencies. Each of these events carries important implications for investors, and by the end of this update, you'll have a clearer understanding of how to position your portfolio in these evolving times. Let's begin with some major news from the Federal Reserve. In a press conference earlier today, the Fed chair delivered remarks that have caught the attention of market participants across the board. The key takeaway is that the Fed is hinting at a shift in its current monetary policy stance. With inflationary pressures remaining stubborn and employment figures showing continued strength, the central bank is now considering an accelerated tapering of its asset purchase program, potentially paving the way for a series of interest rate hikes in the near future. In the short term, investors might experience increased volatility. As the prospect of higher interest rates looms, equities, particularly those in growth sectors, could see a downturn as future earnings become less attractive when discounted at higher rates. While bond markets may react with a rise in yields if investors start anticipating a slowdown in the Fed's bond buying program. For the cryptocurrency market, the implications are twofold. On one side, higher interest rates could shift investor preference towards safer, yield-bearing assets like treasury bonds or high-quality corporate debt, potentially reducing the influx of capital into riskier assets such as digital currencies. On the other hand, if these policy moves succeed in reining in inflation and fostering long-term economic stability, we might eventually see renewed investor confidence in the crypto space. Long-term, a more hawkish Fed could help temper runaway inflation, thereby stabilizing the economic environment and supporting sustainable growth. This policy update serves as a reminder for investors to maintain a balanced portfolio and stay nimble, keeping an eye on both the cyclical adjustments and the underlying fundamentals of their investments. Moreover, this update could have ripple effects on global markets. As the US dollar potentially strengthens with higher interest rates, emerging markets might face capital outflows, leading to further adjustments in international investment strategies. Now, shifting gears from monetary policy to fiscal policy, our second headline centers on a monumental legislative move. Congress has just passed an expansive infrastructure spending bill, earmarking nearly $1 trillion for a wide array of projects across the country. This bill is designed to modernize our aging infrastructure, covering everything from roads, bridges, public transit, broadband, internet, and clean energy initiatives. In the immediate wake of this announcement, market sentiment has turned decidedly optimistic. Stocks in sectors such as construction engineering and industrial materials have experienced a noticeable uptick as investors anticipate that the injection of government funds will create a surge in demand for infrastructure-related services and products. Companies positioned to secure government contracts or those involved in the supply chains for these projects are likely to benefit from this fiscal boost. Looking deeper, the long-term implications of the infrastructure bill are profound. Beyond the immediate stimulus, this spending is expected to drive significant improvements in productivity by reducing logistical bottlenecks, lowering transportation costs, and enhancing connectivity across regions. For local economies, this could mean job creation on a massive scale, which in turn fuels consumer spending and supports overall economic growth. However, there are also challenges to consider. Funding a $1 trillion initiative is no small feat. Investors will be keeping a close eye on how the government plans to finance this bill, whether through increased borrowing tax adjustments or a combination of both. Any missteps in fiscal management could introduce inflationary pressures or elevate national debt concerns, which might temper the bill's positive effects over time. For those looking to capitalize on these developments, sectors such as construction, renewable energy, and tech companies involved in smart infrastructure solutions might present attractive opportunities. ETFs focusing on industrial or infrastructure stocks could serve as a balanced way to tap into this growth, providing diversified exposure while mitigating some of the inherent risks. Furthermore, the infrastructure bill isn't just about physical assets, it's also a catalyst for innovation. As new projects come online, there's likely to be a surge in technological advancements aimed at making infrastructure more efficient and sustainable. This convergence of fiscal stimulus and technological innovation is a key trend to watch, as it has the potential to reshape how industries operate well into the future. Finally, let's turn our attention to a headline that's been stirring conversation in both traditional finance and the digital world: a comprehensive new regulatory framework for cryptocurrencies. Earlier today, the U.S. Securities and Exchange Commission, in coordination with other regulatory bodies, announced plans to implement clearer guidelines and oversight mechanisms for the rapidly evolving crypto market. This regulatory initiative is aimed at striking a balance between fostering innovation in the digital asset space and ensuring investor protection. In the short term, the market reaction has been mixed. Some investors are cautiously optimistic, viewing this move as a step towards legitimizing the crypto market. With clearer rules in place, the murky waters of regulatory uncertainty might finally give way to greater stability, attracting institutional investors who have been on the sidelines due to the risks associated with a loosely regulated market. However, the new framework also raises concerns among crypto entrepreneurs and market participants. Stricter rules could impose significant compliance burdens on crypto exchanges and blockchain startups, potentially slowing down innovation and increasing operational costs. In the near term, this might lead to temporary market corrections as businesses recalibrate their strategies and investors adjust to the new regulatory landscape. Over the long term, though, this regulatory clarity could be a game changer. A well-regulated crypto market can bolster investor confidence and attract a broader base of participants, from retail investors to large institutional players. By establishing a more predictable environment, the framework may help reduce the extreme volatility that has characterized the crypto market in the past, leading to more sustainable growth. For investors, the key takeaway is to view this as both a risk and an opportunity. On one side, there may be short-term fluctuations as the market adjusts. On the other, the long-term benefits of a regulated and more mature market could be significant. This could be an ideal time to explore diversified crypto investments, perhaps through ETFs or mutual funds that focus on digital assets, thereby spreading risk while capturing potential upside. The new regulatory environment might also have spillover effects on related sectors such as fintech, blockchain technology, and even traditional financial services. As banks and financial institutions increasingly explore digital asset integration, clearer regulations will likely pave the way for more innovative financial products and services, further blurring the lines between conventional finance and the digital revolution. As we wrap up today's update, let's quickly recap the 3 key economic developments we discussed. First, the Federal Reserve's potential shift toward a tighter monetary policy signals a period of adjustment for markets, suggesting that both traditional investments and riskier assets like cryptocurrencies may face increased volatility in the short term, but with the promise of greater stability in the long run. Second, the historic infrastructure spending bill passed by Congress not only offers an immediate boost to sectors like construction and engineering, but also sets the stage for long-term economic growth through improved productivity and innovation. And third, the unveiling of a comprehensive crypto regulatory framework marks a pivotal moment in the maturation of the digital asset market, providing clarity and stability that could benefit investors across the board. Each of these events underscores the dynamic and ever-changing nature of our economic landscape. They remind us that while market conditions can be unpredictable, staying informed and adaptable is key to unlocking your financial potential. By understanding these trends and adjusting your investment strategies accordingly, you can position yourself to not only weather market uncertainties, but also capitalize on emerging opportunities. I encourage you to keep a close eye on these developments in the weeks ahead. Whether it's tracking the Fed's next move, watching the rollout of the infrastructure projects, or monitoring how the crypto market evolves under the new regulations, staying proactive is essential. As always, do your own research and consider speaking with a financial advisor to tailor your investment approach to your personal goals and risk tolerance. Thank you for joining me on this in-depth exploration of today's economic news. If you found this update helpful, please give this video a thumbs up, subscribe to our channel, and hit that notification bell so you won't miss any of our future insights. Remember, staying informed is the first step to making smart investment decisions. This is Elite Finance Insights. Signing off, until next time, happy investing and have a fantastic Wednesday.